Hey, everybody. Thank you for joining us on this week's podcast. Joseph and I are here on Thursday, August 8th. Been a while since you were on the podcast. Unfortunately, your car's having trouble, so I think that's why you're here on a Thursday.
It is. I was fortunately having some issues with my car, so I had to leave it outside the office yesterday. Got dropped off today.
And I'm going to take advantage.
Hopefully it was fixed, and then But I feel like I'm always on the podcast when markets aren't doing well.
We bring in the big guns when the markets aren't doing well.
I don't know if that's the case.
I saw that you were in. I'm like, I'm definitely going to take advantage of him being in the office this morning, lure him onto the podcast.
Yeah.
And mainly because he's putting a bunch of stuff in our report lately. I think the one thing that we're going to jump off from today was a piece from Tuesday. Really like three big things that have happened in the market over the past week. You saw what I would call a pretty significant blowout in volatility. Mm-hmm. You had some of the mega caps start to break down and really continue to break down. And then you've also had this whole like yen carry trade take a bunch of headlines. Mm-hmm. So we'll try to explain a bit more. But I think the obvious place to start is the volatility blowout. And you put a piece in the report just talking about the VIX. So maybe just set the stage, like what exactly happened with VIX and volatility. Then we'll get into some of the cases that why or how we got to that.
Yeah, I mean, it was definitely one of the biggest spikes in volatility that we've seen. I think from a percent increase on what Ian wrote on Monday, it was the largest like 3-day increase in the VIX ever. What we've really seen is like the short-term VIX really move higher, and then for example, the VIX 3 months out, which just uses the same calculation on options expiring in 3 months rather than 30 days. Mm-hmm. Is a lot lower than the spot VIX. Usually that indicates like there's obviously a lot of panic in the market and things like that. Once that gets back to normal, usually it's a sign that calm's taking over, at least in the short term. There's obviously longer term forces going on in the market. But for that short term spike in volatility, that usually signals that it's over. Because
typically the VIX curve is upward slope, which makes sense. Like typically people expect volatility to go up.
Yeah, there's more uncertainty the further out you go, essentially. So that's abnormal. That usually doesn't happen. It was one of the biggest spreads we've seen between the 3-month VIX and the spot VIX ever from a closing value standpoint. I didn't look at the intraday high and lows. It was probably one of the highest ever.
Yeah.
A couple other dates are like March 23rd, 2020, which is a huge bottom. You got December 24th, 2018, which is a huge bottom.
Yeah, Christmas Eve massacre.
Now there was a lot more downside in equities at that point in time for COVID, and then also Christmas Eve massacre, whatever you want to call it. The market was pretty weak a couple months leading up to that anyway.
True.
But I think the general thing is like you would expect a bounce to happen around these levels. And when you look at something other than, volatility and the VIX curve and things like that, like the yen was kind of what really kicked this thing off, or at least people just got caught really off guard with this move.
I mean, that's like, I didn't see anybody talking about that ahead of time, which is what always happens with like outsized moves in the market. It's always a surprise. Yeah. It's never some like drip recessionary fears. There's always going to be some shock to the system.
Yeah. Yeah. And we talked about, like, I think I wrote a couple of weeks ago, it's like how index volatility was a lot lower than average individual stock volatility, which happens occasionally, but that's usually when you see a situation where you're primed for volatility to have a pretty large increase. Now, I didn't think it was going to be this nuts. I thought it was like, oh, we'll get the VIX back above 20 or something by the end of the year. I don't think we get up to like 60, but you also have these backdrops that are, you have tender ready to just catch fire. Just need something to drop a match on. It just depends like how much gasoline and things are already on there. And it seems like that, the carry trade really unwinding was, they put a lot of gasoline on that fire real quick.
And I think for people that don't really understand that at a high level, you can explain more clearly is that investors were borrowing at a cheap rate in yen, and they were investing that money to earn a higher interest rate elsewhere. So when interest rates in Japan started going up quite aggressively, people have to unwind that trade because they can't, or they're not as sure that they can earn a higher rate of return elsewhere than the interest rate that they're going to have to pay back on the yen that that they borrowed.
Exactly.
Is, I guess, my interpretation of what went on there.
Yeah, and if it's crowded enough and if it's not priced into a lot of these people's volatility models when it comes to like currency volatility and things like that, then like their risk measures go crazy and they're like, okay, we just got to sell. Like we got to de-risk and degross all of our exposure or a good amount of our exposure, which is why it happens so fast.
I remember I was looking at this because it's actually quite complex because you borrow in yen, then you have to convert it to wherever you're going to invest it, and then to pay back you have to convert again. So you have currency exposure risk, which is why you've seen the dollar move all over the place in the past week, and then you also have the actual hurdle that you have to clear for your investment. So it makes sense to see that unwind. I saw JP Morgan today say that they think like most of it has unwinded, but not all. I don't know what percent they threw out, but it was high, but not 100.
Yeah, I mean, I couldn't tell you for sure. I mean, you never know, who's swimming naked until the tide goes out. It's the famous Buffett quote. When VIX was at 60 Monday morning, I was like, okay, well, we're close to some type of short-term bottom at least. I think there's other long-term stuff we'll eventually talk about.
Sure,
but when you see those explosive moves like that, you're like, okay, if the VIX is at 60. You're pricing in like a 4% move a day, which obviously isn't sustainable. It can last a little bit, but it's not something that's going to, last forever.
Yeah, because we did see a bounce on Tuesday. We opened high on Wednesday and then it sold off. And we were down like 1% yesterday, at least for the S&P. And like today, when we're recording, we're up pretty nicely. And I think the market's just like looking for a reason to bounce right now because we got some revisions of like jobs data or employment data that was like marginally better than expected. So the market's like, all right, we'll take it.
Yeah, and it's kind of this weird situation where because the yen was strengthening, the dollar was weakening. Anything that kind of helps the dollar stabilize a little bit is going to be pretty good. And I think that's why the strong jobs data was good.
Helping that,
people are maybe pricing in less easing and things like that.
Yeah. So. Circling back to the VIX thing, and then we can move elsewhere. The study that we put in the report is like, and what we were talking to when you get backwardation in the VIX curve, which is not the usual slope, but also when you have these like massive one-day spikes. If you isolated it, and I've seen conflicting studies on this for the record, but the way that we looked at it is like markets typically did fine going forward when you had these massive moves. There were some big outliers. So like average, if negative, is not good, but at a hit rate percentage, markets typically did fine. And that's the world that we live in. Like markets go up 70% of the time, sure. 75% of the time, but people spend all their energy and effort trying to figure out 25% of the time that that's not going to happen and how bad it's going to be. Because people hate losing money more than they like making money.
Yeah, and those big downturns are probably the biggest opportunities to make money also. Like if you're able to protect the 20% downturn where everybody else is taking a 20% hit, that's huge.
Yeah, it's tremendous because you can keep compounding your money at a higher dollar value. Anyways, all right. So I think we've said what we want to say on the VIX and like maybe what happened with the yen. So now mega caps have been a story, at least technically for us as of late. You put what was it, XLG?
I just use that as a proxy. It's not like perfect, but because I would say it's even more narrow than just the top 50. It's really top 6 or 7 stocks, max 7 or whatever it is, whatever you want to call it.
The whole technical story has been this slow trend of underperformance. Like you've seen the average stock do much better than the mega cap stocks. I was looking at over the past 30 days. I think the equal weight S&P is up maybe 0.5%, about flat, and the S&P cap weight was like down 6. So you've had a pretty big dispersion. Even on trend charts, you're seeing a lot of lower highs, lower bottoms, consecutive sell signals for some of the mega cap growth stocks, which we've been wanting to see the average stock do better and outperform. Russell 2000, I'll throw in there too. But of course, there's going to be a lot of pain when the mega caps do start falling.
It's just so concentrated. The market's really like, at least the S&P cap weight is just so reliant on those few names. Even though we've seen breadth improve, it's not enough when the top 5 stocks are make up a quarter of the index or whatever it is. So. And there's a lot of, so there's some ugly chart breaks there. You can say some of it's because of the short-term volatility spike, but you look at some of these stocks like consecutive sell signals, big breakdowns through some strong support levels.
Yeah.
And even if you look at kind of before the volatility spike, like XLG was kind of putting in this series of lower highs, really for the first time in a while. So I think that's something to continue to take note of. And breadth improving is good. Like if you're able to own stuff that's not, NVIDIA, Apple, Microsoft, that works well, I mean, you're gonna help generate alpha relative to the benchmark, which is, a good thing. The problem is the market's so just relying on these, they'll drag everything else down with them too, to an extent.
And they have such a big footprint too, not just in terms of market cap, but in jobs. Like how many people work for these companies, their impact on, global export, like a lot more than you would think. So there is a rightful emphasis on them.
Mm-hmm.
But to your point, in the investing landscape, if we have opportunities to own more than just the big guys, your chances of outperforming go up, and that's good. It's going to be uncomfortable to get there, but it's probably good in the long run.
Yeah, and I will say, like, we've seen what would be the beginning stages of a trend change, but we haven't seen enough to say like, oh, this is like definitely, the mega caps are toast, like they're done.
Yeah.
But I think we are seeing some weakness develop that we haven't seen in, probably since the start of this year or the end of last year.
Yeah.
So.
All right. Last thing I think we can chat about today is like more explicitly on the fixed income side. Jamie's putting a report out today looking at high yield spreads. I put a piece in our report earlier this week talking about the high yield spread bounce that was pretty significant. Mm-hmm. So what we mean is that compared to a risk-free rate, bonds that are not risk-free, high yield bonds, that spread between the risk-free bond and the high yield bond, if that widens, that means that there's a higher required return that those issuers have to pay because investors perceive greater risk that they may default or not be able to make their payments. So when high yield spreads rise, typically there's some concern in the economy and by extension, the market. So Jamie's looking at that today, but I think more broadly, we could talk about at least fixed income expectations for the market. 50 basis point cut in September is now becoming more likely.
Yeah, I mean, I think Monday morning, the odds went up to over 90% for a 50 basis point cut. They backed off a bit since then because the pendulum always swings back a little bit. But yeah, I mean, we went from Powell saying, oh, well, we'll cut like when the data says on, last Fed meeting or whatever, and then straight to a 50 basis points cut like a week and a half later.
I was seeing some comments say that if they did some emergency 50 basis point cut, it would freak the market out again.
Oh yeah, I think it would. It'd
like pre-COVID
panic type of deal. So I think the longer running story is like the yield curve's been inverted for 2 years now. Now that people make a big deal out of it, everything that we've done is when the yield curve becomes inverted, it's not the biggest issue. It's usually when it disinverts, uninverts, whatever the term you want to use.
Because that means likely that there's an issue with the economy.
They're cutting rates.
Short-term rates for what reason?
Yeah, they're cutting them lower. Either they've nailed the soft landing or things are bad. It's like it's one or the other. Historically speaking, if you look at times where the yield curve has been inverted for more than 30 days, and we're looking at the 10 2-year spread or the 2 10-year spread. Prior to 2000, the forward returns were actually pretty good. A lot of that happened in the 80s, coming out of that high interest rate environment in the 70s, which you could say, oh, we have higher interest rates now, but back then it was much higher.
Inflation was worse too, in some ways,
Since 2000, it's been much more of either a bad scenario or the forward returns for the market aren't very good. They're not like awful, but they're not very good. You have, normalization dates like since 2000 was December 2000. You have March, July of 06, and then you have March of 07. And then obviously we're still in a inverted yield curve state right now, but we are getting really close, as I think James is going to touch on today. But when you start to talk about Fed cuts, it's almost like it's going to revert back to normal at some point relatively soon. Bonds typically do actually very well from a forward because they're falling.
Yeah.
Yeah, which makes sense.
Yeah. All right, cool. Any other things you think are worth hitting on? We talked about most everything that we've chatted about in the report over the last week. We talk more qualitatively today, and I say more about a fundamental level, but a lot of the things that informed what we're saying were based off of data, based off of like prior studies that we've run and put in the report. Yeah. Because like we are technical people at the end of the day, but we also want to use the technicals to make sense of what's going on at a qualitative and a fundamental level. So if you want some more color on what we've been saying, check out the report for the past few days. I don't have a ton other to say. I mean, copper's down, like everything else is down, because I think people are sour on the economy right now, maybe. Yeah. But jury's still out on that, for the record. I mean, who knows what's actually going to come of all of this? It could just be a jump scare.
Yeah, I mean, because it's been kind of hard to, with all the narratives going on, separate them a little bit. I think what you've seen the last couple of days is mostly because of that carry trade unwinding and a lot of degrossing by some big firms. Prior to that, I mean, we were seeing the economy weaken to an extent, like with the employment data that came out. Now we had like a slightly positive jobs report this morning, but I think the labor markets, from a fundamental standpoint, is the thing to continue to watch moving forward. You've seen like headlines like, I know a few companies have laid off a couple thousand employees and things like that. So that's, I think, what I'm watching, pretty closely on a fundamental side. And then I'm going to be looking at how do rates move here moving forward, because they came down so fast that they've almost done a little bit of that's job by easing rates a little bit. So we'll see if that has any impacts on, what their decision-making process is moving forward. People went from maybe we'll get a 50 basis point cut to, we're certainly getting a 50 basis point cut to now it's back down a little bit. So I think that's going to be pretty important to watch. How's the fixed income market holding up?
Yeah. All right. I think it's a good place to call it today. Appreciate everybody listening per usual. Thanks for having car issues and coming in this morning.
Yeah.
We'll talk to y'all next week. Thanks.